The broadcast is now starting. All attendees are in listen-only mode.
Hey guys, I hope you're well and welcome to this special webinar. It's about the coronavirus. My webcam should be on right now. I'm doing this from home, as you know. London is pretty much soon potentially going to be on lockdown, and I'm doing this from my home office. If you're new to this, my name is Alejandro Zambrano, and I'm the Global Chief Market Strategist with ATFX. And before that, you might remember the broker FXCM, Forex Capital Markets. I used to be the head of the London team there, and I worked for Daily FX and FXCM from 2009 to 2016. And then I became the Chief Market Strategist with Amana Capital, which is one of the Middle East's biggest brokers, and now I'm with ATFX. So we're going to talk about the coronavirus. Going to show you a few charts. Going to look at things that have how the SARS incident in 2003, how that influenced the markets, and we're going to look at some of the data and try to understand what is happening with the markets today. So that's what we're going to be doing. If you do have any questions throughout the presentation, you're most welcome to ask them. But it's just myself here, so I'm going to be toggling between your questions and the screens. So I might not necessarily see everything as you write it to me. We can actually begin looking at the chat already, or the questions. If you can hear me well and see my screen and see my camera, then please let me know. We have a few people here, and I'm very happy to see all of you guys here. A lot of new faces. I think most of you guys are from ADVFN, which we work together with and do things like this, where we present content for the readers of ADVFN as well. You might even read some of my stuff that has been published here. Okay, so Nikos is telling me that everything is good, audio and visual good. So thank you so much. Okay, good. So let's begin. I'm gonna share my screen with you. Let's see if I'm sharing the right screen. And then we're going to get going. Okay, good. All right, so we're going to talk about the coronavirus. And we're going to look a bit at how things developed with the SARS breakout in 2003 to try to understand what happened then and how we can use that information to what may happen this time around. In fact, it's already been very helpful when it comes down to China, the way people reacted to the coronavirus. And we're starting to see some of these signs here. Like, even though the numbers are terrible, the situation in Italy is improving, and I will explain to you guys relatively soon why that is the case. At least improving for the markets, because that's really what's important. Well, obviously that's not necessarily what is the most important, but if you're a speculator, then yeah, that's what you're looking at, and I guess that's why you guys are here. Okay, so you should now only be able to see my screen. So hopefully that's going to be better for you. Let's just make sure that is the right one. Good. All right, good. So let's get going here then. Before we start, though, by the way, so let me just introduce you guys. So again, my name is Alejandro Zambrano. That's me here on CNBC. I was on CNBC early today, doing it from Skype today because of the situation. And again, I've been working in the industry for quite some time, and I've been trading since 2006. And I'm a profitable trader since 2014, and I've been working for FCA regulated brokers since I started working in London in 2009 after I completed my master's. So hopefully you'll stick around with me for the next half an hour or 40 minutes, and hopefully I can teach you and support you guys in your trading to hopefully understand the markets a bit better. If you do have any preferred markets, then you're most welcome to just put that in the chat box. What I'm going to be doing is I'm going to cover the main markets, and in particular the Dow Jones, but we can of course look at the DAX and the FTSE 100. We can also look at currencies, even though the effect on currencies is not as straightforward unless you're trading the Australian dollar, where the situation is really straightforward. Now, before we start, as always, I need to stress that trading financial markets, unfortunately, is high risk, and we may lose all of our invested money as well. Any of the content here is made with an educational purpose. And I do also represent the broker ATFX, and ATFX has its own risk disclaimer, and 67% of their retail clients lose money when trading CFDs. So it's really important you understand that it's a high risk product. And obviously the reason why it's a high risk product is because it's on leverage, and people like to over leverage. The market is moving a lot right now, but people still trade with leverage. Even I trade with leverage, and if you do it badly, you can lose out quite a lot. So bear that in mind. Okay, guys. So let's talk a little bit about the coronavirus, which pretty much started in November, December last year. But then when first in January, actually, where things started to become more the world started to pick it up. I actually picked it up really early because I was actually in Hong Kong myself for meetings on clients, and this was in the third week of January that I was there, and I think I was back in London on the 21st of January. So I read about it and I saw some movements in the markets, and I remember speaking with my colleague over there that is based in the Hong Kong office, and he's like, "Oh yeah, that's the Wuhan flu. I don't worry so much about that. I think people are just booking profits in the Shanghai stock markets because it's the Chinese New Year, and people want to reduce risk because the stock market is going to be closed." But he misunderstood the gravity. And you know what? I didn't fully understand the gravity that much in the beginning, but I do know how to calculate growth rates, because as an investor, you're always looking at your trading account and you say, all right, I did 25% this year. What if I do 25% over the next 5 years? Or what if I do, 10% every month? Is that possible? So when you start to work with exponential numbers like I do, and I've been doing that for many years, then when you were looking at the numbers, the way they were increasing in China, it was really clear to me very, very early on that this is going to become really, really nasty. So in fact, when I came back on January 21st. So on January 23rd, I went out and bought masks for myself and my family. And already then, if you wanted to get hold of a 3M mask, which is what I bought to myself and my family, if you were trying to buy that on Amazon, it was already like a 2-week delay. So what I did, I had to go to a local Screwfix, which is a do-it-yourself shop that they have here in the UK, and over there I could pick it up, and I got myself some three masks, uh, and then things obviously just turned more and worse and worse, and now people are fighting about toilet paper. Now, but heading into it though, there was not a lot of people thinking about it. So in January 20, you had 275 cases, and this is actually the Shanghai Stock Exchange, and you can see how the market was going upwards. And my colleague had done this analysis, and she was drawing a trend line and putting that question mark there, and there was already talks about it, but there was not too much focus on it yet. But fast forward, right? So this is on January 20th. So fast forward with just one day or so, and you have this big slide here on January 21st. That's 326 cases from January 21st. Come January 22nd, and the number of cases have increased to 547. So 547 over 326. I mean, that's a growth of 67%. So obviously in my head, I start to blow this up. So if I raise this with 7, that's a factor of 37 times. 37 by 547. Oh, we're going to have 20,000 cases in 7 days in China if it continues to grow with that. So obviously when I come back, I buy those masks. Now what happens here is that they go for the Chinese New Year, they close the markets, and from the time they close the market on the 23rd until February 3rd, the cases have increased with 19,000 to 19,700. 19,700 over 639. That's a growth rate of 30% in just a week or so, a little bit more than a week here in China. And again, that sort of told me that this market is, it's a difficult one. It's actually 2 weeks to be exact, pretty much 2 weeks. No, sorry. Yeah, it's like 1 week. Yeah, it's 1 week plus 1, 2, 3, over 3 days, trading days or so. So almost 2 weeks. But what happens here, at this point here, is that you have, that's the highest number, that's the highest increase. And already a few days before that, they have put Wuhan and Hubei um, uh, region under quarantined. That's when you could read that 50 million people have been under lockdown. So obviously this would have some sort of effect. And sure, it did. Around this time, the number of cases peaked percentage-wise. And that was really important because we started from having a very, very aggressive growth rate, but by February 6th or so, the growth rate was at 11%, which was not very high. So the growth rate is really important for the markets. And what's also really important for the markets is that the governments take action. And as you can read now, they're taking a lot of action, the different governments. So we're definitely going in the right direction, but we're not there yet. And I'm going to show you in a few minutes why I think we're not there yet. So first things first, what happened here? Okay, they pumped a lot of money in, they locked their cities down, and the growth rate declined. So when the growth rate bottomed out, that is when we saw the market heading higher. Let me show you the classic Corona. This is the Corona page that has been, we've been floating around for quite some time. And we're gonna see here. So this is daily cases. So you can see here that on February 4th, we had 4,000 cases. Now this is not a percentage. This is just 4,000 new confirmed cases. And from there, we pretty much moved lower and lower and lower. And then of course they made a huge change to the system, how they and things, the backdated things, and and you got that huge increase. But then things slowed down again. And the Shanghai stock markets and also the Hong Kong stock market initially did bottom out around these days. We can take a look at that actually. Let's take a look at the Shanghai Stock Exchange. So this is the Shanghai Stock Exchange, and here on this is the 3rd, and on the 4th the market jumped higher, and then from then it went pretty much higher. And if you look at the daily rate here, that the market bottomed out pretty much when we had the highest growth rate here. So that's the first lesson. And I got quite curious to see what happened in 2003. Well, this is what happened in 2003. So these are probable cases of SARS, which had in higher death rate, so more dangerous. And you had the cases. So these are the cases, the increment in cases. So this is March. You can see how we have a huge number of cases, and I think it's because they did a lot of counting, or they showed a lot of the results. Then you can see how the cases increase and increase and increase and increase. And about by the end of April, you can see we have the highest number of cases, and then it declined, it declined, and declined. And what happened then in the markets at that point? Well, you have 3 different markets here. You got in orange, you got the Nikkei, which is the Japanese stock markets. You had the Shanghai Composite in this color here, and then you have in blue, you have the Hang Seng Stock Index. That was the Hong Kong Stock Index. Now, if you look at where people like the fatality rate and where people got the amount of cases, you can see that Hong Kong was on number 2 and China was in number 1st here. But people were far more concerned in Hong Kong, and the fatality rate here was 17%. So obviously you can imagine how people were scared in Hong Kong back then. But what was quite interesting is that the Japanese stock market and the Hong Kong exchange, which you can see here in blue, went down and down and down. And by the end of April, on the 28th, the market bottomed out. So the market bottomed out. That was exactly when we had the highest growth number of cases here. What's also interesting is we can learn a few things, and this is that the World Health Organization issued a global alert, and they did that for the coronavirus as well. But then the countries in Southeast Asia held a meeting, and China, and they decided to do something about it. And from that day, things started to go upwards. Now, fast forward here on May 20th, World Health Organization, they refused to lift the travel warning for Hong Kong and China. And then when the market had already risen from being, in the case of the Hong Kong market here, it was negative about 10%, and then it was plus 5%. When they lifted it, the market had already recuperated. And the reason for this as well, it's really important to understand how the I can't even pronounce it now. World Health Organization, how they operate and how governments operate. So the World Health Organization, if you look up their homepage, you will see that they want to balance risk for the economy and the risk for health. That means that they will many times wait with issuing warnings. So they're waiting for things to see how they develop. And then after the fact, they will come out with the warnings. And in this case, it required a pandemic sign or like a warning before more governments join in the battle here. Because when they warn like that, then you have an excuse. You can say, well, the health organization is doing this and we need to do something about it. Before that, no one was doing too much about it. But what is interesting is that they sort of lagging things. So you're going to see some reports coming out where they're going to say, well, the problems are still with us. And they might be right. But by the time they tell us that it's fine, the markets would already have risen with some 15, in this case, maybe 20% the way things have developed right now. But we can learn a few interesting things here. Both in the first leg of the coronavirus, when we have the highest amount of cases, that's when the stock markets bottomed out. In the SARS as well, when the government started to take action and we had the highest amount of cases, that is when the market bottomed out. So that's the first thing. The second thing as well is, again, the World Health Organization is lagging a bit. So what's happening now then? So we have the situation in Italy, right? So I've been using these webcams. They're very useful because you can actually see what's going on in the cities. So just a few days ago, this was not a few days ago, before the lockdown, which started on Monday, I think started on Monday, March 9. Before that, there used to be a lot of different people here. And this was, here's the police, but there was people all around here, all right? Now you can see there's some people, but there are not a lot of people. And as well, people were like, yeah, but it's just Milan. It's just that's part of the of Italy. And if you were looking at pictures when they were in Rome, like I think this should be a Rome picture, Trevi Fountain in Rome, it was still packed with people. There we go. Let's buy some toothpaste. It was actually full with people, but now they've locked that down. On Twitter, let's see if I can go to my Twitter. I put this just a few days ago. So I put this on March 13th. That's on Friday last week. So on Friday last week, I published this image from Puerta del Sol in Madrid. You can see all these people here not really worrying too much about the situation. I guess they're all very young. They don't really care. Look at that now. How does that look like today? Well, it looks like this. So you can see how it's pretty much empty. The three people you see here, that's police. Not sure what that is. But just on Friday last week, you had people sitting on the square here, enjoying an ice cream or whatever they're doing, hanging out with people. You see how packed it is. And this, of course, had to change. Because if you look at the number of cases in Italy, it sort of skyrocketed. And the problem is many of these places, they just have maybe 3,000 or maybe 5,000 beds for intensive care. So if you have a lot of people having this disease at the same time, you won't have ventilators for everyone. You won't have antibiotics for everyone. And that is the problem. That is why we are under a lockdown. Now, things have, I'm based in London, in Spain, okay, that has now been sorted. People are not allowed to go out the same as before. This is a very good start. The second thing now is, of course, the UK, where they're going to close schools from tomorrow. And there's still a lot of people in there because in the UK, they have not told people that it's mandatory to stay home. So people are still doing, going to the office. In fact, I was at the office yesterday. It's just from today, I'm starting to work from home. And I worked a few days as well before that. So I did my part, and I'm trying to do my part not to get infected. So when someone really needs it, there's not me taking up a bed there. Anyway, this is good, but it's not all very good in New York, unfortunately. In New York, people are still busy. So this is in Madison Square Garden, and you can see how people are busy and people going out, they're not doing their part. And I think this is going to needs to be on the lockdown like they did in San Francisco before we can start to talk about this diminishing. And using webcams like this is a very, very useful tool to get an idea if we're anywhere near finding a low in the markets. Now let's take a look a bit in at the Italian cases, right? So there's this site here which is called Our World in Data, and I'll send you this link because it's very useful. So you want to keep an eye on that. Let's see if I can find the chat. I can't find the chat now, so I'll send it to you later. But the growth rate is interesting. So you can see here the cases in Italy. Like yesterday, the official number was for an increase of 3,233 cases. Now, if you look at that, and this is the arithmetic change, you might say, oh, wow, that's a high number. And I don't disagree. It is a high number. That's a lot of people. And 1 to maybe 2-3% of those are going to die. But if you look at the numbers from percentage growth, then the situation is actually a bit different. So I prepared this chart for us. So in the very, very beginning, you had an increase of 67 cases. So the total for that day, 24 days ago, 25 days ago, was an increase of 88%, right? And then you have some very, very high numbers. On average in China, you had a growth rate of some 35%. But then that settled when they did the quarantine. And let's take a look at this. Let's actually adjust this a bit because it looks a bit aggressive when we do like that. And if we adjust this, let's lower this a bit. So we do it like that. You can see that the growth rate of cases have actually decreased. And this is important. This is minus 10 days ago, which is when they introduced the lockdown. And you can see at that point, the growth rate was 21%. The day after was just 20. Then you had a very low number of 10. And then you had up to 19. And then you had up to 14. And then you had a growth rate of 17. And then you had a growth rate of 12. And that's the latest reading. They haven't updated the data. Maybe updated now, but let's take a look at that actually if they updated. The update very late in Italy, or not very late, but so there's a move here of 4,000. So let's do like this. We're just gonna make it very simple, and then we go back to our spreadsheet. Just a second. So there's an increase of 4,000 cases. And the total cases are now 35,713. And I'm just doing it super simple here. I'm just taking the new one over the total, and that gives me a growth rate of 12%. So if you might be scared now and say, hold on, what's going on in Italy? We just had that massive increase. Percentage-wise, it's the same growth rate we had before. If I was only trading the Italian stock market and the Italian stock market was the biggest one, I would be buying stocks right now in Italy, because this is telling me that the situation is abating in Italy. But it's not just that. We have France, we have Germany, and we have Spain, and we have the UK, and we have the US, with the US being the most important one from an economic point of view, a stock market point of view. So what you want to do over the next few days, if you want to trade on the back of this, because I do believe when the people realize that this is slowing down, I think we're going to have some significant moves in the stock markets. Of course, right now, you know, like companies like Lufthansa, Air France are just on their knees. SAS, so the Scandinavian Airlines company, they told that up to 90% of their staff, they told them to literally just don't come to work. That's a way as well for them to be able to claim benefits, these people, by putting them under risk of losing their jobs. Most likely they're going to get some government help and so on, and they're going to come back. So they're definitely going to be damage here. Like companies that are fragile, that have high debt, that weren't making so much money to begin with and that were struggling, well, they're going bust most likely, unless they get some government help. But healthy companies, like a company like Apple, they're going to be around. People are going to be buying their phones. No question about that. 2 years from now, 1 year from now, people are going to be buying their phones. I don't doubt that. Some apparel, like the Gucci stuff, very popular in China. People are gonna buy that in 2 years. They're still gonna be buying those shoes. It's gonna cost them 500 pounds, but they're still gonna be buying them. Burberry, for example, it's also still gonna be around. Will all car makers be around? Probably. Car makers are really important, but what I'm trying to tell you here is that good companies are going to be around. The stock markets will bounce, but obviously we're having all these problems here. And the longer it takes to bring the economy back, the more time, the more damage is going to be. That's why the Chinese government is very keen as well on adding to on getting their economy back up again. So that's something to bear in mind. So what I would like to do, and what I'm doing myself, in fact, I'm just keeping an eye on the Spanish data. Now Spain just added this on Monday, so it just started. France as well effectively just added on just recently, and you have as well Germany. I haven't looked. I haven't seen any. Let's see if they have. Let's check if we can find a webcam. Webcam Berlin. Okay, time lapse. We need to spend some time here finding that, but yeah, I will need to spend some time there, but it will be interesting to see. This is Berlin last year, so that's not active anymore. See if you can find one for Berlin as well. That would be interesting to see. And Frankfurt, of course, as well, to see if there is a lot of activity out. If there's not a lot of activity out, then that would be a good indication that things could start to stabilize. So that's sort of your macro fundamental point of view. That's what I will be focusing on. And bear in mind, all of the data is going to be terrible coming out. You remember the Chinese data, the PMI? So the PMI for February was around 49 or something. The PMI started, it was like 32 or 37, was sort of the lowest level we've seen ever in the PMI and numbers. And that's why the stock market here tumbled the way they did. In places like Norway, the unemployment rate went from about 2.5% to 5%. That's why the euro, Norwegian kroner, literally is just getting hammered. Like, it's not often, like in this year, the currency has softened with 25%, 24 to be exact, at one point 26. I mean, this is like almost like what we saw, for example, with the Turkish lira. And we're talking about Norway. It's a rich country. They produce a lot of crude oil. I mean, they're super rich. If you ever been to Norway, it's crazy expensive over there. Like a pizza is, I don't know how much, maybe 15 pounds or something like that. So, not more. It's very, very expensive over there. But their currency is treated like, it's an emerging market currency. Anyway, let's see what can we do here. What can we focus on? So my preference is the Dow Jones. So the Dow Jones, I already bought myself, full disclosure. I bought last week. So in sort of low or no leverage positions, so mutual funds and stuff like that, I already bought. I bought end of last week. I'm a little bit underwater here, but I bought somewhere down here, so maybe I'm down with some maybe some 8% on this. However, I'm not gonna cash out anytime soon. So the drawdown is the following. So the drawdown is 35% from its annual high. So the way it works is like this. If the drawdown is between 10 to 20%, the market will recuperate that loss within 4 months. If the drawdown is more than 20%, then it's going to take 2 years to recuperate the loss. So realistically, it's going to take 2 years for this market to go back all the way up now because of the drawdown. Now, if you look at what happened in 2008, which was a situation where it was really, really bad, then let me see what I clicked on the wrong button. And then at that point, the market went down with 56%. Now went down with 35. So in the Dow Jones, and I guess most of you guys are old enough to remember back then what happened. But if we decline with 55% here, well, then we're gonna be back at levels seen in 2012, which were the same levels we saw in 2017, which were the same levels we saw here in 2010 almost. So, but say we come down here, so 2007. So that means this market would have lost some 13 years of data or 13 years of return. So we need to ask ourselves, hasn't the world improved? Isn't the world a better place now, at least economically, compared with 13 years ago? I do know, for example, that poverty across the world has been improved substantially. There's far less very poor people than we had before. There's a lot of building happening. There's a lot of things that have improved compared with 2007, I think. So I don't necessarily think it's justified that these companies should be trading at these levels if they will go down all the way down there. So the first thing I would do is, again, be ready, because I personally think maybe not right now. US needs to lock down. When they lock down properly, give it 2 weeks. At that point, the growth rate in the US should slow down, and by that point, most of things would have been okay in Europe as well. And that could be the beginning of this potentially bottoming out. And we're pretty much at these levels. There's some big levels here at these levels here. So that would be 15,185. We're reaching into that zone, and I will be very surprised if we don't bottom out above this level. And what I can just tell you what I'm gonna do, and obviously what you do is up to you, but in these periods when you have these bear markets, it will last maybe 2 years, but then 2-3 years down the line, it will be up higher again. And what I'm just gonna be doing is I'm just gonna be buying and buying and buying and buying every month, and then 3-4 years from now, in worst case 3-4 years, my average entry is gonna be pretty much around the low, and these markets are gonna be up by maybe 20-30%. Because even if we have just a normal correction, so if I put some Fibonacci on this one from the very high to the very low, even if we just go up to the first fib and just retest these lows here, if that would bounce today, that would be a 20% return, which is not bad. So I'm looking at these levels here. Now there's another little trick here which I like to use, and I just like to focus on the lower and lower highs. So in the very short term, now at least, you can see how the market is trading lower and lower and lower. And as long as you're creating these low and lower highs, I would not be buying with a CFD broker like ATFX. You can if you know what you're doing. In the past, I think I bought some of these corrections here for that little push, and then I've been looking to grab some of these things because the corrections here are also a bit crazy. For example, if the market is down with here, for example, if the market is down from here to here, the market was down with about 20% in a very short period of time. Of course, it's gonna bounce a little bit, and then if you know what you're doing, you can buy and you can make some good returns on the upside. So it is possible to buy on these extreme levels as well if you wanted to. But if you're looking for that long-term trade, then you're looking at these levels here. What about the FTSE 100 then? So the FTSE 100 is, because of its link to the commodity markets, it's unfortunately even more bearish. So if we look at it from a daily chart, the drawdown here is, well, it's 34% actually, so it's not that bad actually. I'll take it back what I said. Here you have some very interesting levels, which is these levels here at 4,768. And that is what I will be looking at, being bullish there. But if you look at this from a short-term perspective, so if you look at the 4-hour, the market's actually not that bad when I look at it. So if we look at the 1-hour, you can clearly see actually how this market here has started to stabilize. So just because we take out 5,319 doesn't necessarily mean that it's going to bottom out and just rather like crazy, but it can definitely maybe go up to the next high and then a little bit lower and then a little bit higher and then a little bit lower and then hopefully a little bit higher. So that is what I'm looking for. If we look at the German DAX, I'm bearish here from the beginning, by the way. So I'm bearish from this level up here. And let's just clean this up a bit because we can't see what we're doing. So my idea has just been to sell here and then attack the lows. But here as well, if you look at it from a big picture perspective, we're pretty much back at the same level since 2013. I'm quite sure that the German companies that made up of the DAX have done some good progress in the last 13 years. Here, the historical drawdown in 2000, and we can't see it here. Let's see if we can load. So this is the DAX index. Okay, so we're down with 38%. From the year 2000 up until 2013, they sold off, wow, 72%. That's some crazy moves. Here in the loss in the Great Recession, Great Financial Recession, 56%. So this one here does potentially have a bit more to give up. Looks like the Germans definitely like to sell their stocks, send them much more lower. We did take out a bunch of levels here. So maybe here is more important even that you keep an eye on the downtrends. You keep an eye on these highs, making sure that as long as we're trading these lower and lower highs, you want to remain on the bearish side and not be buying unless you are a very long-term investor and happy to buy here and then continue to buy over the next few years. If we look at currencies, GBP USD is driven by other stuff. It's not just about Corona, but it is also because of Corona. So we pretty much reached my first target, which is 113.65, but there's some more targets. Like this goes straight through support here, and this is a trend line, gives you a big descending triangle. Break here can potentially take you down to 101.98. Think about that. That's quite an aggressive decline. The reason is, why is this declining more than the euro? That's the question I received today on CNBC. Well, the problem with the thing here is that with the UK, they have Brexit negotiation, they have trade talks, and as far as I can remember, they put into law that if there's no deal before the end of the year, they're just gonna go out on World Trade Organization terms. That would surely force the pound lower to compensate, because if you have tariffs, say you have tariffs of 10% just for the sake of it, so for the Europeans, it's going to be a situation where, all right, they don't want to pay those 10%. But what if the pound declines with 10%? Well, they're going to be able to buy what they want to buy from you. So they'll buy those 10 cars or whatever they want to buy, those 10 Rolls-Royce engines for their airplanes. But because currency is down with 10%, the manufacturer gets his pounds, they get their engines, and everything is good. The difference, though, is that when the manufacturer of the engine, Rolls-Royce, wants to go out in the world, then they need to pay 10% more. But if they're happy just to stay in the UK, then that's fine. The problem with the UK as well is that they import a lot of food. So what will probably happen is that the domestic market would increase its production. So there's balances there, but I think that could be the number one reason why this is, because it's not going to be possible to have some serious talks when your country and your people are dying in the UK and in the rest of Europe. The second thing as well, the euro, because it has very low interest rates, it has been a funding currency. So you can go to euro area since 2015 or so. You can go to the euro area and you can take a loan. That loan, if you're a big institution, you can probably borrow for like 1%, if not less. You take that and you can put that, or you could have put that in the US and put that into the bond market or lent it out there, and you would have a very nice return. And if you do that with leverage, then even more. So you put 10,000, to give an example, you put 100,000 with your bank in Europe as a deposit, and then they will lend you $1 million. And then you take that $1 million, you invest that in the US, you do some investments, you buy as well some Apple stocks, whatever's going up, you get that income. The problem is when everything comes down crashing, everybody wants to head for the exit at the same time. And that is why the euro is also so supported. Finally, let's talk a bit about gold then. So why is gold not higher? Well, then I think the number one reason here with gold is that people and hedge fund managers, they buy stock market indices. And then as a precaution, they buy bonds. And that's why you have that classic combination, like 60% bonds, 60% stocks and 40% bonds. So what happens is you will get your return on the bonds, but when the market as well is crashing, you're going to get capital appreciation on the bonds as well. So the bond price could go up and you make money by just holding the bond. And if it doesn't work out, you just keep the bond until it matures 10 years later and you get your money back. So that's the problem is at one point bonds were not increasing as the stock markets were going down. So the hedge that you wanted to have was not there anymore. The same thing with gold. You would buy some gold as a hedge, but then at one point you need to take some of the profits in treasuries and in gold to pay for losses in your stock market holdings. And that is why at one point we're seeing bonds going down, we're seeing gold going down, and you see stock markets going down. At that point, there's no escape of it. The only thing that would escape you from risk will be cash. And cash is king, as we know. Okay, guys, let's see if you have any questions. I hope you enjoyed that. Let's see if you guys have any questions. I'll see if I can help you. So you can just put them in the chat box. So I'm not gonna share the slides, but what I can do is that I'm going to, the video is going to be shared with you guys. So I don't usually share slides. I spend a lot of time on them, and the last thing I want to see is I want to see them floating. I'm not saying you're gonna float them around on the internet, but it takes some time to collect things. I hope you don't mind. As well, before we wrap things up, I do a daily market update on investingcube.com and on the ATFX YouTube channel. So on webinars here, you can actually watch. So every day I do a market update. It looks like this. This one I did this today. Because I'm streaming at the same time, it doesn't really work right now, but I share my screen. So you can actually follow me, see what I'm doing, so you can understand when I think it's time to turn bullish from the short-term perspective. And let me just see if I can write back to you guys. I don't know. Not really working for me today. The website, anyways, here we go. There we go. So I'll send that to you, all of you guys, so you have that. As well, if you like this style, like educational style as well, if you want to learn more about how I trade, I am having a deal with ATFX where there's an educational course that you get for free. And you get it for free as long as you have an account with ATFX. And that's that. It's definitely much more Forex centric, but it is something that covers technical analysis. And the technical analysis bits, you can use that for stock market indices. And it's a great way to quickly learn a few new techniques and hopefully help with the trading, find some new ideas. Because, for example, I operate with about 3 different systems. One longer term breakout system, I got a range bound system, and then I got my short term one. And it's not always that all the systems work really good. And that is why I flip around with the different systems. Sometimes I trade with the short term, sometimes I trade with the long term, sometimes I trade stocks, sometimes I trade Forex, sometimes I trade commodities. And I cover those strategies here. So you get my experience from 2006 up until summer of last year in that course. And you get that for free as long as you have an ATFX account. The way they operate is that if you have an account with them, when you trade, you pay the spread, which is very small to begin with. And that's how they everybody wins. You get the education, and they get some of the some commission or some return every time you trade. Of course, you trade more, you make more money, everybody's happier because they make more on the spreads because you would trade more often. Okay, let's see if you guys have any questions. As well, I am on Twitter, so you can definitely check that out. Let's see if I can find my slides again. You can reach me on info@mscube.com, but you have my Twitter as well on AlexFX00. See if I can send you that. If you guys have any questions now, the floor is open. I'll send you as well the link to the data, so you can use that. That's my Twitter, it's free to follow, and the link to the data is over here. When we wrap things up, the video should be coming out to you, so you should be able to watch that one. And I'm sure it comes out. If you don't get it, I do have you on. I have the emails to everyone, so I'll reply back to you to the email you used. Okay, so you got a question about gold prices in the very short term. Okay, so let's take a look at that. So gold prices, if we just hide everything, you can see that they're just above this important low, which is 1,444. And then you have several days the market's tried to attack the low, but it hasn't really managed to trade lower. So this is a bit of profit-taking candles. Now, I was bullish here as well, and that did not work out, but now it's starting to look more and more interesting. And if you look at the market today, and if we look at something like the 1-hour chart, then I'm actually bullish from 1490, and I'll be bullish as long as trade about 1445. If we do get like a daily close or a push below here, 1445, then we're probably going to go down to the next level, which is 1,399. So we'll probably go lower here if that would happen. But I'm short and bullish for now. Okay, we don't have any more questions, so I think we're going to wrap things up. I want to thank you so much for watching, and I want to welcome you guys to follow me on Twitter. Check out investingcube.com as well, because I do the daily market updates, so we can be in touch. And if you follow me on Twitter, again, you can check out my stuff. I send out messages when I go live, and I do more and more educational stuff. As well, if you are interested in the other educational stuff, we have that as well. You can just reach out to me at info@investingcube.com, or you can just fill out that form in the link I sent to you guys, and someone is going to be in touch with you. Most likely, if you European based, it's going to be someone from the London office. If not, it's going to be someone from the overseas branch, which are closer to you. Okay, guys, stay safe out there. Be careful with your health, and I hope to see you guys soon. Hopefully already tomorrow, as we take a look at the markets at 9:45 a.m. London time on investingcube.com. Thanks so much, and I'll see you guys hopefully tomorrow. Bye-bye.